Good morning. Today is Friday, April 16th, 2021. This market commentary title is It's a Bull Market, Watch Exposure. And this is your weekend report. Hey, this is Jonathan Gurney, Portfolio Manager at Gurney Financial. The purpose of these videos is to educate and keep clients aware of what is happening in the stock market. Our goal is to close the gap in communication between clients and the actual person managing their assets. We use a combination of fundamentals and technicals as part of our analysis. We hope the charts and education help clients and viewers alike. A friendly reminder, this video is not to be taken as financial advice, just informational purposes only, mainly keeping clients aware of what we are thinking. So let's hit the charts. Okay, so again, this is mid-session. It is 11:07 in the morning. Want to kind of go over some charts, what we're seeing. Right now, I'm going to update this real quick. The index has had a pretty good week. 1 second, it's updating. Not a bad week whatsoever. The S&P 500 has actually done quite well as the Dow. Tech had a great week as well. Small caps kind of struggled. It's had an okay week, but nothing great. So we're going to show you those charts. So as you can see, the S&P 500 here, we got out of consolidation here. This did not feel good in the index, in individual stocks. We got hit hard here. Again, if you're in the index, if this is a 6-7% dip, that's going to be a much larger dip in individual names, and we usually like to hold individual names, okay? So we did get hit hard there. During these dips, we have been adding exposure to small caps, which unfortunately has not really taken, hasn't really taken off yet. It has been the leader this year, the Russell 2000. It's still in consolidation mode, but we'll talk about that shortly. In short, had another test toward the end of April. We said April is probably going to be a much better situation, and it has rallied hard. And as you can see here, the RSI is now at 74. So we're pretty high. It doesn't mean we can't stay here, but I'm reducing exposure, just being a realist, saying, hey, risk appetite is usually not great up here. You can scalp, but it's just not great risk exposure. So we've been reducing positions in our growth names that had gotten hit hard, had a little bit of a rally. Rates this week in general, with the exception of today, have really seen a move down. And right now on Friday, it's seeing a move back up. So I'm glad we made some moves in some of the tech names, the growth names. Despite what the news is saying, it's in what the indexes are showing. It's actually been a very, very difficult market. Rotations almost every day. Tech had a great rally this week. We'll show you the indexes. So that's the S&P 500. The Dow, one of the strongest performers. And again, RSI of 73.9. Again, a lot of stocks doing incredibly well. Unfortunately for us, just being candid with you, it has not been a great year for us. We were doing great to basically the beginning of March, and we then got hit hard in individual names. And we've been trying to play some catch up, but we know when we see this kind of exposure, you got to be a little bit careful. And you might ask, hey, things seem great in the news. Why are you backing off? Well, things are really good in the news, but I'm also going to be a realist to say when price action gets this high in RSI, it can remain here, but you're probably going to see it a 2 to 3% dip, and that's a much better entry. So just being a realist there. The NASDAQ, or the QQQ, again, a very, very strong week. I mean, that's very impressive, mainly because of rates. So not quite overbought. We tapped overbought. Kind of in no man's land today. Nothing really noteworthy to add there. Just rates. Yesterday saw a big downtick. Now they're seeing a big uptick. Now let's show you the Russell 2000, which again, we've been allocating toward, but man, has that been a frustrating trade. It's just not going anywhere thus far. Again, it's flat today, but you can see we've been kind of buying all through here and have gotten nothing out of it yet. So I do think that this is where I want to be, especially throughout the rest of the year. And again, I'm going to be in and out of things, but I do want to continue to position here because it is the comeback trade, and I do believe rates will go higher. As with things improving, I think naturally rates will increase. But if COVID continues to worsen, we get the variant and the vaccines just aren't working, these trades will get hit and I'll be the heck out of this trade. So it's been frustrating. We were in some momentum growth. We were in allocated some to value, and neither has worked. So it's been very frustrating. Underperforming candidly, the indexes, not a fun situation. But I'm going to be a realist and say, hey, this is not a great time to take a ton of risk. So I have a lot in the small cap value areas. I don't mind banks here because, again, I think rates are going to go higher. So energy is interesting, but it's still a very volatile trade. That's more of a scalp trade for me than anything, not really anything long-term personally. So there are the indexes. Now let's get into some charts. So now we're on to 5, the put call ratio. You know, we've definitely been lower, but it is, as of yesterday, right at 48. So we're not really in the danger zone, but I think people are being a little bit reasonable here, and that's actually why the indexes are going a little bit higher. I think some people are shorting or protecting their portfolios, and it's squeezing the market a little bit higher. So just understand that if you're not a client of mine, don't be surprised in the next week or so that you see a 2 to 3% dip somewhere within there. It'll probably get bought. Maybe sometime in May we see more of a 7, 8, 9% dip. That happens every year, and I'm going to try to prevent as much of that as possible. So there's the put call ratio. The VIX, we talked about this. Seeing the VIX trend below 20 is a very good thing. We've been there plenty of years before. As you see, we're getting into that range where, hey, would it really be surprising if we see a little pop scare? Not at all. So in short, we filled the gap in this range, and we're in a bull market. So it's a bull market, but we got to be realistic and not get too greedy. So I have some catch up to do this year. There's no doubt about it, but we have to be cautious in putting on a large exposure after this kind of rally. So again, the indexes have not told the real tale. They're doing well, and we're well aware of that. But a lot of momentum growth names have gotten hit. Small cap value and growth has really not gone anywhere for a month. So we've kind of gotten hit twice. It's kind of frustrating. It's very frustrating. Hang in there because I do believe we rotate to the value. I don't have much momentum growth left with exposure. So TLT, which is 20-year plus bonds, you can see the trend is higher, but I think you got to be really, really careful here. I don't have any interest in bonds, but this is a pretty big move down. So would it surprise you? We'll see. We shall see. The Treasury Yield, which I'm more interested in analyzing than TLT. We talked about this line. This is basically the level where we were pre-pandemic, right around 1.6. We're right on these levels right now. This has gone and teetered higher today. This is as of Thursday, so has teetered higher today. I do think rates do go higher, and that will be a beneficiary to the comeback trade. So it may take time because, again, those names have rallied a lot. So it might take some time, and we might need a breather before any of this even happens. So that's the difficult situation that we are in. As many areas are already overbought. This is really interesting. It kind of shows you how overbought we actually are. This is as of yesterday, 96%, the highest number since 2002, I believe. Around 2009, I believe. Well, I believe in right around this range here, and here we were right in the 96 range. But we're getting a little bit cooked. Okay, a lot of areas are very hot. And that's why I'm reducing exposure in the high momentum growth names. Guys, I mean, this was an ETF that was loved last year, did incredibly well, but it's just getting hit pretty hard. And I'm going to show you the top 10 holdings and kind of show you Tesla's doing okay, had a nice rebound. But like, again, these aren't all names that I own. It's just to show you that, hey, a lot of these names that were doing well last year are not doing well this year. So you got to change and shift strategy. So TDOC, you're seeing here, by no means is this doing anything spectacular. 1 second. Again, struggling to, I mean, that's from 310 to 170 and struggling to get higher when the market is doing well. So just know that things are not as easy as the indexes are hiding. And this very well could be a year where, you know, I might decide that on a pullback, indexes might be the best way to play this year. I think you got to take each year individually and say, where's the opportunity? And this year, man, have a lot of these names gotten hit hard. I mean, even a Roku, which again is a stay-at-home name, has really struggled. I mean, went from 500 486 to, I mean, guys, a lot of these names went down 50-40% and are really struggling to get over their 50-day moving averages, which is not a good thing. So on a lot of these names, again, I didn't own Roku, but on a lot of these gains that we've seen recently and the rate increase as yields, went down, growth names got a bid, I'm not so sure these names are going to continue to go higher. I would love to see that because it's good for the market. Rotations are good for the market, and that's why a lot of the indexes are okay because they're so broadly exposed. I personally had a lot of value and a lot of growth, but both got hit at the same time. And that's why we are struggling, because value hasn't played catch up and momentum growth really is struggling to get out of a rut. So truthfully, we got hit twice. We're doing okay, and I think we're going to be completely fine this year, but I'm not going to be pressing the gas pedal hard here. Again, this is history is something to watch, but it could go completely off the cuff and not follow this whatsoever. But it is interesting. This is showing you 2009, 2010 versus, so the last recession and the comeback versus now. And the green is 2009, 2010. The orange is right where we are right now. Okay? So the point being, it is follow this almost spot on. So would it really surprise you to see something this, you know, an 7 to 8% pullback? Do we go to, I mean, this is a pretty significant dip, and that's what I think we got to be aware of, is usually the market does well when things are bad. A lot of people don't understand that, but the market does really well because they think things are going to continue to go up, up, up. Things will improve. Well, now we're getting a lot of this improvement. In fact, a lot of the economics that we saw this week were extremely strong. I think there's definitely room to run this year, and I think we're much higher by the end of the year. But you're going to see every year likely a 10% dip somewhere within the year. And it would not surprise me to see that happen in the next couple months. So I'm going to watch my exposure and use this opportunity to play catch up. So again, in short, I think it's going to be a good year, but I'm going to be realistic at overbought levels. The areas I'm in right now are not overbought, so I'm okay to stay there for a little bit longer. I want to see if we can get a little more juice out of this. Again, I'm a bull, so I think the market has proven itself during good and bad times that it can do extremely well. But are you going to see 3-5% dips every year and 1-10% dip in the year? That's normal. It's frustrating, and I'm very frustrated with my performance this year. But we have to take it for where we are now, and that's where we stand. We kind of got hit twice, and hopefully this reduction in exposure at elevated levels, again, we might see a 2 to 3% dip here, kind of like it did toward the end of April and maybe see another little quick rally. I think it goes to value names, to be honest with you. So that's kind of our game plan. I hope this helps. Again, hang in there. Let us know if you have any questions, but that's just kind of our game plan. You can see in the account, I'm reducing high growth names. Rates had a nice move down, gave those names a nice little recovery. I'm really thinking growth could potentially struggle here. I think it'll always be fine. I just don't know if the outperformance is going to be there. So I continue to look for names that are more the comeback trade, especially on pullbacks. And that's kind of what I'm saying. A little bit cooked in the Dow and S&P 500. The Russell 2000 looks more interesting to me at these levels, but it has had outperformance the entire year. So you got to be careful, but let us know if you have questions. We're here for you. I know it's been frustrating. The indexes have made me look like an idiot this year, and sometimes that happens. A lot of times individual name exposure outperforms significantly during good times. That's not necessarily been the case. It's we've been definitely well diversified between value and growth, but neither really did well for us, and that's really frustrating. So don't be surprised if we take a little more conservative approach on a dip and do more index based. I think it's kind of one of those years where, if you get a down movement, be careful how much exposure you put on. Sure, risk reward, but if you see a 15% dip, don't miss the move is kind of where I'm coming from. So hope this helps. Let us know if you have questions. Have a great rest of the day.